Hi, everybody. Welcome to Stop Being Sold, a community of informed consumers who are sick and tired of being sold financial products that they don't need or understand. So if you are tired of being a transaction, go ahead and hit that subscribe button and notification bell so you never miss another video from us. How are you today, Brian?
Hey, Michelle, doing great. Thank you.
Good, good. So today we're talking about costly 401k rollover mistakes. This is a big one. It is, right? Especially we've seen a record number of people exiting the workforce. Now, whether they go back or what they do now, that's not what we're talking about. We are talking about people who are leaving the workforce and who may be leaving 401ks behind. So if that's you, that need to pay attention to this video. And since spring, this is insane. What do we have? 20 million, since spring 2021, we have a record 20 million people who have resigned and left the workforce. And August was, I think, the highest at 4.3 million people exiting or quitting.
Yeah. And we don't know if they're going to, because of the pandemic, they're staying at home because their kids are at home. That could be a huge part of it. And I think, Michelle, what people have realized during the pandemic, we're going on 18, 20 months now, probably 20 months now since. But you think about that, in 20 months, how many people realized that they didn't actually need both incomes to survive?
Right.
And
so priorities definitely have shifted.
Switched back to one of the parents staying home with their children. Or what you're also seeing is the upgrade of your status of your employment position.
Right.
So many people are hiring at elevated wages and benefits and bonuses, sign-on bonuses. I mean, it's just ridiculous. So people may have, during this time frame, upgraded their job also.
Absolutely. All right. Well, that being said, if you have a 401k and you have it, have 1, 2, 3 there. I know someone who's got 4 of them. People are changing jobs more often than they used to. This video is for you, and you do want to avoid these costly mistakes. So there are 4 of them. Start with the first one. Leaving it behind, your 401k behind with your past employer. Not a good idea. It is your money. It is your responsibility. Your past employer is not taking care of that 401k for you.
Yeah, and think of it this way, Michelle. Compare it to, your 401k sitting in that statement, in that envelope over there that says 401k statement on it that you've never opened.
Right.
You know what it's doing if you're leaving it behind, right? So the problem with your account being with your past employer is it still remains subject to whatever rules were in that plan.
Right.
Again, limited investment options to only what was in that plan. And like you said, person with 4 of them, you got another account to keep up with.
Right.
And lastly, what about the fees?
Fees. If you're in a high fee account, it will eat away at your balance.
Yes, definitely.
For sure. All right. So number 2, rolling over your funds indirectly.
Okay.
So I'm going to back it up. Let's explain the difference between indirect and direct really quickly, and then we'll dive into why you want to avoid, I should say, indirect rollovers.
Okay, so a direct rollover, you can take your old 401k and roll it directly. So from your 401k, let's say it was at Fidelity, and you have an IRA at TD Ameritrade. You can roll your old 401k from Fidelity to TD Ameritrade as a direct rollover or direct transfer, and the check doesn't come to you. You didn't get the check. You didn't have the opportunity to cash it. It was sent directly from custodian to custodian.
Okay.
Indirectly is complete opposite. They mail you the check. And that's what we're going to talk about here. The problem with indirect rollovers, because they come with a lot of stipulations and penalties.
Right. So let's go through those. What's one of the first stipulations?
Okay, automatically. So, and this is a big one. I've got phone calls from people before said, look, I'm looking to take money out, take my old 401k and just cash it out. But that company, my old company told me they're going to hold 20% for taxes. What? So you hear that and they're automatically withhold the 20% because that is the IRS guidelines. So what if they withhold 20%, you've got to, whatever's left, you've got to go and deposit that into a new IRA within 60 days, or you'll have to pay the penalties, which are 10% penalty if it's pre-59, if you're under 59 and a half years old. But you still have to worry about next year because 20% they held, if you don't make up that 20%, now you're taxed and penalized on that 20% also. So,
and you can only do one there with indirect rollovers. You can only do one a year. Is that correct? Or in a 12-month period?
It used to be many of them you could do, but now it's one in a 12-month period. Unlike a direct rollover, like we explained in the beginning, the direct rollover you can do as many as you want. So what if you are over 59 and a half and you're moving, you want to do an indirect? What are the penalties different? Yeah, well, if you're over 59 and a half, the 10% penalty no longer applies, but they still will withhold that 20% because that's mandated. So.
Okay. And can you split the transfer? So if you get a check for your 401k, can you split the transfer among multiple accounts? For example, can you put some in a Roth and some in a traditional IRA, or wherever the heck you want to do? Or can it only go into one account?
No, you can split it because, so in that 60-day, you can split it because a lot of the old 401ks have Roth provisions in them. So you'll need to split them. But remember, you're only allowed one rollover per year. Okay. So if you're doing a rollover from your old 401k to an IRA and they mail you the check and you redeposit it later, you can only go in one account. It's that simple. Okay. So only that one rollover, they're going to penalize you on that.
All right. So costly mistake number 3 would be rolling over your 401k too soon. Let's talk about that.
Yeah, this is real simple too. Like we was talking about before, taking the money out pre-59 and a half, 10% penalties on that, taxes on your withdrawals. Now, think about this. Not many advisors know this rule, and let's be careful on this. A lot of people that decide they're 55 years old and or between 55 and 59 and a half. They decide that they want to roll their funds over, do this, do that. And, there's a 55 rule. The key with this 55 rule is if you're over 55 in the calendar year that you leave your job, you can take penalty-free withdrawals from your old 401k plan. You still have to pay taxes on it, but you'll avoid paying penalties. And here's where this is important. In a past video we've done, blog posts we've talked about this quite often, is that people that with old 401ks are a target for financial advisors that all they do is focus on rollovers, right?
Right.
What if you're 56 years old, Michelle, and you've got this old 401k and you meet with an advisor and the advisor says, oh, that's real simple, just roll it over. Well, you roll over to a new company, you did a direct transfer, it doesn't really matter, or indirect transfer, it doesn't matter, either one. You did that. But now a year later, you could have used some of that money. An emergency came up. Well, here's the issue. Now, because you rolled it to an IRA, now you're obligated. It's no longer the company's 401k plan. You now will pay that 10% penalty where you wouldn't have paid it if you left it in your 401k. So there's a window of opportunity at age 55 to 59 and a half that you really need to make sure what you want to do with them funds. And
that's called the over 55 rule?
Over 55 rule. And not many advisors know this. So, and I've seen these mistakes many times where someone just rolls to an IRA, someone calls and says, hey, I need to take money on my IRA. Well, you could have taken out your 401k without that 10% penalty because you're over 55. So
Okay.
very important rule.
Got it. Okay. And the costly mistake number 4. This is a big one. If you have company stock, rolling over your company stock.
Yeah. So, and you're seeing a lot of this. So if your old 401k has shares of your former employer's stock that's appreciated over the years, I mean, it's grown over the years, right? Some cases, rolling over the stock into an IRA is going to be a huge mistake. So 401k plan distributions are subject to ordinary income taxes.
Right.
However, there's a special rule that applies that when you receive a tax distribution of employee stock from your plan, the rule's called net unrealized appreciation, or NUA for the NUA rule. You'll only pay ordinary income tax on the cost basis of the stock. The cost basis is the stock price at the time that was purchased for you by the plan. Any appreciation in that, Michelle, will receive favorable long-term capital gains rate. So taxes are completely different on that. So you have to be careful. Here's the issue. If the NUA rule does not apply if you roll over the stock into an IRA. Have to be careful on this.
Okay. That's a big one. That's actually a big one.
Very big. So think about this. For example, let's say you got Facebook stock. You work at Facebook. You got Facebook stock options over the years, and look how much it's appreciated over time, right? And you go to switch jobs. You no longer want to work for Facebook. You want to go to Google, whatever. Be careful on that rollover process. If you've got the stock in there, that's why you really need to work with a fiduciary that truly understands the rules.
Absolutely. All right. Well, thank you so much, Brian, for this information today. Thanks for everybody who's watching. If you like this content, please hit that like button, the thumbs up button there, and also make sure you subscribe to this video or subscribe to our channel so you don't miss another video. Thanks, everybody.
Thanks, everyone. Have a great day.